Hi all, welcome to this video. In this video, I'm going to quickly discuss what is the correct approach that beginners who are just starting with trading, or who are new to trading, or who are not able to be profitable yet should take to improve their trading ability. So let me first go to a blank page, and actually we can discuss what a market is. So market is nothing but it is a place which gives you a kind of uh, opportunity to buy or share any commodity. So here let's call that commodity as stocks or options or futures or any crude oil or any sugar or that kind of commodities. So basically, it is a place which enables or provides a platform to buy and sell these commodities. And it is not like, I mean, for every buy, there has to be a counter sell order in the system. So it cannot happen that you can just go and buy and no one is selling it to you. So there is a fixed set of quantity, and uh, if you are buying, there is a owner who sold it to you at that particular cost that you bought it at. Even if you are shorting a market and you currently don't own it, but when you created this sell position, someone bought at that position, and when, let's say, market moves in your direction and you buy it over here, then someone kind of sold in that position. So there is always a counter order to whatever order you place. This is important to understand. So when you say that it is a bullish bar or it is a bearish bar, so it does not mean that everyone here sold. Everyone here only sold. It means that people were ready to sell at any price in this location, but obviously at each of that tick or each of that location, someone bought it. So people who are selling may think that, okay, I think this is market is going to go down from here, and people who are buying, maybe they are thinking that this has come down a lot, this is like a pullback, and from here the market will go up. So they are ready, they think this is a value zone, and that's why they are buying it over here, right? So if you see, the volume actually does not tell you whether it is a bearish volume or a bullish volume. It just tells you that these many transactions happened in between these two particular price points. The color of the bar tells you that which side was kind of, stronger, in the sense that they were ready to sell at any of these levels. I mean, there were more people who were selling at these levels than there were people who were buying at these levels. Only that causes the price to move down or up. So if there are more people or more orders than sell orders at all these locations, then slowly the price will increase, right? So this is important to understand. And the other thing is also that one needs to keep in mind is that when a candle is formed, actually, let's say a stock gets listed for the first time, and this happened, let's say, 10 years back. So whatever activity in that stock happened over the past 10 years, it is one single activity. It is not broken down. So this listed 10 years back over here, and from that it is continuously going up, down, whatever, but it is one single activity that is happening in the market. What you see in the charts is actually you are breaking, like as a market participant, you are breaking that activity down into smaller chunks so that you understand or make sense out of it. So this is not how a actual day looks. So the actual day, just like the year we said, it is one single activity, but you have broken it down into 3-minute chart to kind of understand what is happening. So some may break it down at 3 minutes, some at 15, some at 1 minute. This depends on the person who is trading and what his approach to trading is. So keeping these 2 points in mind, we need to now move to the third point, which is there are innumerable variables that are involved in the market, and that's why we can never predict the market moves. So for example, if you go to this chart, you can never tell when the market opens that is it going to go down or is it going to go up. You should not go into that predicting business, because we don't know how many market participants are there, what is the intent behind their trades, what is their emotional state currently, where are big orders and their stop losses placed. Some people may have some insider info or may be privy to some information which may make them take counter trades to what the price action suggests. So there are so many motives and so many participants involved that it becomes such a complex system that even the supercomputers cannot predict what is going to happen over a particular day. So now that we have understood that this is such a complex system, so for example, on a 3-minute time frame, this may look as a big fall in the price, but a person who is trading, let's say, the 4-hour time frame may think that okay, this is a small correction or a pullback which I should buy into. So you may think that prices are falling and who is buying in this particular red candle. But for a person on the 4-hour time frame, this may be a pullback on some level from wherein he expects the market to go up and he may buy it over here, right? So everyone has different intents and everyone is trading with a different viewpoint. So it is basically it is everyone has a difference of opinion, and those two people are transacting at each of these points. So the thing is, therefore, we should never go into predicting markets. What we should try to do is, we should try to be aware of what is happening in the market and then try to figure out a location from where we can trade. So what beginners or what people who are new to trading or who are not profitable yet, or what people generally tend to do is they think that market is something that I need to understand. I need to be able to understand the market movements throughout the day for me to be able to trade successfully. However, this is not the truth. So actually it is the other way around. You don't need to understand the markets. You don't need any super formula, secret strategy, or any kind of indicator that will tell you from where the market is going to take a turn, or whether it is going to trend today, or whether it is going to open gap up or gap down. You don't need to get into this business of predicting and trying to understand and analyze markets. That is not how you should approach your trading, because if you try to do that, the market is so random. As I said, it has so many participants and it is so random. No strategy, no indicator is going to help you all the time. And if you start going into using multiple indicators with large number of indicators and patterns and moving averages and everything on the chart, you will have everything other than the price, which is the most important thing on the chart. So always keep in mind that you don't have to find out any like a secret, some secret behind this to and try to understand the market or why it is moving. You don't need to go into the reasons of it. To be able to make money, all you need to be do is you should be able to identify low risk trading zones during a particular day. So if this is the day that is unfolding in front of you, so you should be able to identify, you don't care whether the price is going to go up or down. So all you need to do is you need to identify a low risk trading zone. So can this be a low risk trading zone when the market has opened? Yes, it has pulled up from one of the pivot supports, but look at the where will you keep your stop loss if you are going to buy over here. This is below this line because you will have to give that much space to the trade, right? You don't know. This is a big risk you are taking. This is the basically the risk you are taking, and it is not a low risk setup if you see, because the market has just opened. There it is a pin bar kind of bar, but there was some selling over here. You don't know what is going to happen, and see, price did move up, but again there were some sellers over here and they brought the market down, right? So then was this a good location to trade? I would say yes, because it did come close to the support and there were some buyers over here and there was a pin bar kind of bar over here and then a green bar. So as soon as the bar is about to close, so this is a 3-minute bar, and in the last 10-15 seconds you could have taken a position over here, and where would you have kept your stop loss? At the just below this pin bar right here. So just see, this is how you have to find out. You don't need to be sure that okay, from here the market is going to go up. You don't care about it. It is not that what you want to figure out while trading. What you want to figure out is where is the risk low risk high reward location, and you have to take it and let the market determine whether you turn out to be successful or not. And because your risk is low, and when you take a profit, it should be at least like twice the amount of risk you take. So for example, if you would have taken it over here, this would have definitely, even if you got exited over here, this would have been a more than a 2x trade for you. So because when you lose less. When you make money more. You will automatically turn into a profitable trader. You don't need to figure out any complex indicator or some complex scientific formula or mathematical formula or some set of indicators together to see and confirm where the trend is going. You don't need all this. All you have to do is find out the low risk reward location and just initiate the trade and assume that it is like a coin toss. So it is a 50% probability of going in your direction or against your direction. So the moment you assume that it is a 50-50 probability, you do not invest yourself into that trade. So you don't feel bad if the trade moves against you, because if you think that okay, I have done this whole analysis and this is the pattern, and definitely market has to be bullish from this point of view, and if you do that and then it breaks it, then because you have invested so much of your self worth behind that analysis, you feel bad, and that starts creating an emotional baggage. So you should always make sure that whenever you initiate a trade, you assume that it is going to be 50% probability of winning, and vice versa, and whatever you were risking, you at least make twice the amount of whatever you're risking. So if you are risking, like here, if you were risking 5 or 7 points, your profit should at least be 10 or 15 or 20 points. So if you start doing this, you will automatically turn into a profitable trader, and you don't need any kind of secret strategy or some complex indicators or anything in your day-to-day trading. Just try to simplify your trading and try to figure out whenever you are analyzing in real time and after real time, and if you're writing a journal or if you are revisiting your trades, try to analyze where you able to figure out the best low risk entry point of the day. Once you start trying to find this over a period of few months, automatically you will be able to identify these positions during real time trading, and that will help you really take a notch higher in your trading. If you are liking the content that I am presenting in these videos, do subscribe to my channel. That would be all. Thanks.